What's up everyone, it's Scotty with Money Investing. So in this video, we are going to be talking about Shopify, ticker symbol SHOP, and I've got a big surprise because now we can finally start to calculate the intrinsic value on Shopify. For the longest time, we weren't able to do that because the company, first of all, was not profitable. Second of all, we didn't really have an understanding of what the earnings might look like next year or 5 years or 10 years down the road. But now we do have analyst estimates. We're going to use those and of course do some assessment on what level of certainty we have with the growth rates, and of course apply our conservative approach, the PE multiples, and of course figure out what the intrinsic value can be for Shopify, what the fair value can be for Shopify in this video, of course, moving forward. So I hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Friendly reminder that the coupon code for the options course, which is 50% off, coupon code LAUNCH, expires in 2 days. So after July 31st, that discount is going to go away, and the 16% annual discount available for the Discord also goes away at the end of this month. So you got 2 more days left if you want to take advantage of both the options course and of course the Discord and the Patreon as well. And of course the bundle, which is fundamental, technical, and options course, all 3 courses in one, is also 50% off, and this also does expire in 2 days at the end of this month. So link's going to be down below if you're interested in joining us. So when it comes to Shopify, the most important metric for this company is called GMV, right? That's the gross merchandise volume. And that basically means how much of transaction, what's the total volume of transactions happening through the Shopify's ecosystem. And that was a little bit over $49.6 billion, and that's up 15% year over year compared to first quarter 22, 18% on a constant currency basis, and outpacing the US e-commerce growth as well. So very strong numbers. And we'll take a look at the attach rate as well, which is basically how much of that revenue, how much of the GMV translates over to the revenue. But speaking of $1.5 billion in revenue in the first quarter, that was up 25% year over year, 1.1 billion coming from merchant solutions and 382 million coming from subscription solutions, which again is going to be a little bit more recurring revenue for the company, right? Merchant solutions, basically if more merchants and sellers are doing a lot of volume, a lot of transactions, that increases the GMV. That obviously leads to more revenue, but subscription services and solutions is going to be more recurring business model for the company, much higher margins for this compared to over here. But eventually this right here is also expected to grow. Only 11% growth. It's much harder to grow this number right here than it is to grow over here, because again, merchants are going to be selling a lot of volume, and that's really what's going to dictate the GMV, which is going to dictate the revenue. Now this right here is the attach rate, which is basically what percentage of the GMV trickles down to the actual revenue line, and that's a little bit over 3%, very strong number there, and that's again reaching a highest level in company history at over 3%. Earlier it was at 2.7% back in the first quarter 2018 as well. And GMV processed on Shopify payments, again, Shopify payments is also part of the Shopify umbrella, and Shopify payments 27.5 billion, that was up 25% on a year-over-year basis. And GPV, that's gross payment volume, penetration at 56%, and penetration down 70 basis points quarter over quarter. So there's actually a lot of businesses that Shopify is now into. Shopify e-commerce, point of sale, Shopify payments, Shopify lending, Shopify balance. There's a lot of things that Shopify is doing. This is a good representation of the full suite of different products and services that they now offer, and mission critical solutions that make it easier for merchants to run and manage a business through Shopify payments, Shopify capital, balance, app store, themes, shipping, tax, protect, flow. There's like a whole wide variety of different products and services, and of course sell wherever the buyers are. Markets Pro, point of sale go, B2B on all these social media services, and of course discover new customers through Shopify audiences, collaborations, and again, different plans that they have to offer as well. So there's just like so many things that Shopify is obviously going to be focusing on and is already doing. Now this is going to be the second quarter 2023 outlook, and they are again going to be reporting their numbers next week. So the revenue growth is expected to be in the similar rate as the first quarter 23 on a year-over-year basis, which is going to be 20-25%. Gross margins expected to be very similar to the first quarter 23, and stock-based compensation expected to be approximately 110 million, and expect to achieve free cash flow profitability for each quarter of 2023. That's also again very important, and that's really where the intrinsic value is coming in from, because the company is now finally turning the corner towards profitability. And second half of 23, they expect more of the benefit from pending sale of logistics business and workforce reduction to materialize. And of course, they're becoming more efficient, doing a little bit of layoffs and incremental investments in key themes, and revenue expected at 1.5 billion, or no, impairment charge and $150 million severance charge as well for the company. Now, this right here, very consistent growth. As you can see, they've gone from 50 million to over $5.5 billion. A very nice, considerable growth here. Gross profit margins also have grown, and 36 million to 2.7 billion in gross profit. But again, the company has not been able to achieve profitability up until now, more recently, that this right here is going to be the actual expectations from 33 cents this year to over $5.23 in 9 years from now. So we'll take a look at what that CAGR looks like. But diluted shares outstanding have also gone higher and higher every single year, but they're stabilizing a little bit more now. So they've gone from like 1 billion to 1.2 billion, so 20% growth in the last 5 years for the company, which obviously is a lot better than the substantial growth we've seen from 370 million to 1 billion. That's over 3x, 300% growth versus 20%. And that's really what happens when you are starting off with a very low number. But once you get to a pretty sizable, pretty high number, then the growth rate obviously slows down. And that's exactly what we're seeing right now for shares outstanding, something that we will price in when we're doing our analysis. Now, moving forward, this right here, the balance sheet, phenomenal. They're sitting on over 4.8, almost $5 billion worth of cash. Total debt's a little bit over 1.4 billion. So net debt is negative 3.4 billion. So negative net debt of $3.46 billion. And of course, very strong current ratio, very significant quick ratio for the business as well. So great balance sheet for the company. And if you come over here, this right here is going to be the earnings expectation. They're expected to grow EPS by over 88%. Almost a 90% growth expected for EPS over the next 5 years. And of course, 9 years, they're expected at almost 36%, with shares outstanding obviously growing by over 14.6%. But if we plug in, let's say, the numbers from, if you go back, so let's just do numbers from 2018, which was 1.056, so 1056.7, and that was 2018. You'll notice the last 4 years, it's only been 4.7%, right? So I think that's going to be a little bit more accurate and a good representation of what the next 5 years might look like for Shopify in terms of share dilution. So we're going to plug in 5% just to be on the safe side. I'm not going to go with 88% growth. You guys know me. The most bullish I can ever be is like 30, maybe 40% growth in this case, because again, the expectations are pretty high and they're turning the corner towards profitability. And once the company actually does become profitable, the earnings growth definitely is a lot higher than compared to when the company's already profitable and the goal is to grow. So 40% growth rate. Valuation multiples right now are pretty high right now. So if you come over here, take a look at the fundamentals for the company, we're looking at a 14 times sales multiple, over 3,600 cash flow multiple. But that again is a little bit misleading because of the non-GAAP versus GAAP adjustments and the price earnings we don't really have. So I'm going to go with 30 times price earnings multiple just because I think 30 times is a good representation of a high growth company that has some pretty good margins and some very strong growth rates at over 40%. 12% discount rate. I'm going to go with a little bit of a higher margin of safety, maybe 15% I think is more reasonable for this company, and we get down to a fair value which is closer to $24 per share. Right now it's trading at over $66 per share as well. If we go with, let's say, 10% margin of safety, we bump that number up to $25. Maybe if we go with 35 times price earnings multiple, considering that PEG ratio needs to be as close to 1 as possible, because that's the thing about PEG ratio, right? PEG ratio is a good representation of the earnings multiple relative to the growth rate. So if it's closer to 1, that's very good. If it's over 1, if it's over 2, then you can all of a sudden kind of try to understand that, okay, the stock itself is a little bit overvalued because it is trading at a higher multiple relative to its growth. If it's below 1, then you can kind of get a good sense of it being undervalued. So right now it's under 1. You can kind of make a case that, I'm not doing justice by giving it a 35 times multiple. Maybe we can go up to as high as 40, and that's when the PEG ratio will be 1, because now Shopify's P multiple will be very consistent with the growth rate itself. And of course, the same thing is going to be true for discount rate, margin of safety, and share dilution. And we get to $33 and almost $34 as the fair value, which, still does mean that it would need a 48, 49% potential pullback from where it's trading at the moment. So this right here is going to be the sensitivity grid for it to be almost trading at where the price is. So like $56, $57, again, 66 is where it's at right now. But to get it even remotely as close to where it's trading right now, we'd have to assume a 48% growth rate and a 50 times P multiple, and that's just a little too high. Like if I make some adjustments to the numbers now, let's just go with 50%, 50%, and you'll notice that now it's at almost $60 per share, the fair value. If we go with 60 and 55, now it is trading at almost $90, right? So these are pretty bold assumptions to make right from the beginning, because I like to be a little bit more conservative. Like I said, I mean, this is 40% is conservative, right, in this world, which is crazy because I would never go with these numbers. Like I would obviously be a lot lower than where it's right now, but I think $33, $34 is reasonable. Actually, you know what? Yeah. So that's going to be that number for Shopify. So let me know in the comment section below, what do you think? But this right here is going to be the technical analysis for this company. Very nice, consistent rally. I mean, it was trading as low as $24, $25. Obviously, it has rallied over 176% from those levels, year to date up over 85%. So a very strong move to the upside. But resistance is going to stay with that close to $66, $67. So this right here is going to be that resistance all the way up to $75 per share. And of course, support level is going to stay put at $54, $55 for the company as well. Now for Shopify, I mean, obviously Amazon's a pretty big competitor, right? Amazon pretty much dominates the entire e-commerce market, but Shopify is definitely doing different things and offering a lot of different types of services. So I don't really necessarily see Shopify as a, kind of like a similar overlap to Amazon, but they are definitely offering a little bit of different services. So they do have a specific moat to their business model that they are running. So for those reasons, I am interested in Shopify. I think this is a company that has a lot of potential upside, but it's just about the valuation. And right now the pricing isn't really right. Even though it's a phenomenal business, even though it's a great company, in my opinion, the valuation, like I said, is a little bit off, considering that it's trading at pretty significant multiples, right? If you do the math right now, $66 divided by 33 cents, it is trading at 200 times earnings multiple, which is just an insane number. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.